The Federal Reserve just gave themselves the legal authority to restrict your access to your own money during what they call periods of financial stress. Read that sentence again. Your money, their rules, their definition of stress, their timeline. For 90 years, since the creation of the FDIC in 1933, Americans have believed one fundamental truth. Money in the bank is safe. Money in the bank is protected. Money in the bank is yours. As of Monday, that truth becomes a myth. And if you do not take action before the rule goes live, you may wake up one morning unable to access the funds you spent a lifetime earning. I am going to show you exactly what this rule says, who pushed for it, why they did it, and most importantly, what you need to do in the next 72 hours to protect yourself. This is not about fear. This is about preparation. Because the prepared will survive what is coming. The unprepared will not. To understand why this rule exists, you need to understand what is happening beneath the surface of the American banking system. Because while the headlines tell you the economy is strong, the banks are healthy, and your deposits are safe, the reality is the opposite. Let me give you a number that the mainstream media refuses to report. $684 billion. That is the amount of unrealized losses currently sitting on the balance sheets of American banks. These are losses that exist but have not been officially recognized. They are hidden, they are papered over, and they are growing every single day. Here is how it works. Banks take your deposits and they invest that money. One of the primary investments they make is in U.S. Treasury bonds and mortgage-backed securities. These are supposed to be the safest assets in the world. They are backed by the full faith and credit of the United States government. The problem is that when interest rates go up, the value of existing bonds goes down. It is an inverse relationship. It is basic math. It is inescapable. In 2021, the Federal Reserve held interest rates near zero. Banks loaded up on long-term bonds paying 1.5% to 2%. They thought rates would stay low forever. Then inflation hit. The Fed raised rates from near zero to over 5% in less than 18 months. That was the fastest rate hiking cycle in 40 years. And it destroyed the value of those bonds. A bond that a bank bought for $100 in 2021 might only be worth $70 today. That is a 30% loss. But here is the accounting trick. As long as the bank does not sell the bond, they do not have to recognize the loss. They can hold it on their books at the original purchase price. They can pretend everything is fine. The regulators allow this. It is called held-to-maturity accounting, and it is a legalized lie. The banks are technically insolvent. They have assets worth less than their liabilities. But as long as nobody forces them to sell those assets, as long as nobody demands their money back, the illusion continues. The problem is that people are starting to demand their money back. That is called a bank run, and the Fed knows one is coming. Silicon Valley Bank was not an anomaly, it was a preview. When SVB collapsed in March 2023, it was the second largest bank failure in American history. It happened in 48 hours. One day, the bank was open. 2 days later, it was seized by regulators. Depositors with more than $250,000 lost access to their funds for weeks. Some businesses could not make payroll. Some never recovered. What killed SVB was exactly what I just described. They held long-term bonds that lost value when rates rose. Depositors got nervous. They started withdrawing. The bank had to sell bonds at a loss to meet withdrawals. The losses became real. Panic spread. The bank died. The Fed looked at Silicon Valley Bank and they did not say, "We need to fix the underlying problem." They did not say, "We need to let rates normalize slowly." They did not say, "We need to force banks to hold more capital." No. They said, "We need to make sure that when the next crisis hits, we can control the withdrawals." That is what this new rule is about. Control, not your protection, their control. Let me walk you through exactly what this rule says. Because the language matters. The specific words they use tell you everything about their intentions. The rule is officially titled Amendment to Regulation DD, Emergency Liquidity Provisions and Depositor Access Protocols. Regulation DD governs truth in savings. It is supposed to protect consumers by requiring banks to disclose terms and conditions. But this amendment adds something new. It adds Section 7, subsection 14, titled Temporary Access Limitations During Systemic Stress Events. Here is the key language, and I am quoting directly from the Federal Reserve document. In the event that the Board of Governors determines that a systemic stress event poses material risk to the stability of the banking system, member institutions may implement temporary limitations on depositor access to funds, including but not limited to daily withdrawal caps, transfer restrictions, and extended settlement periods. Let me translate that from legalese to English. If the Fed decides there is a crisis, your bank can legally limit how much of your own money you can withdraw each day. They can stop you from transferring money to other accounts. They can delay your access to funds indefinitely. And they can do this without your consent, without prior notice, and without any guarantee of when normal access will resume. But it gets worse. The rule defines a systemic stress event extremely broadly. It includes traditional banking crises, yes, but it also includes cyber attacks on financial infrastructure, geopolitical conflicts that impact markets, significant volatility in treasury markets, and here's the one that should concern you the most: public loss of confidence in the banking system. Read that last one again. Public loss of confidence. That means if enough people start withdrawing their money, if enough people start questioning the safety of banks, if enough people start moving to cash or gold or crypto, that itself becomes a systemic stress event. Your rational response to risk becomes the justification for restricting your access. This is circular logic designed to trap you. If you trust the banks, you leave your money in. If you do not trust the banks and try to withdraw, that lack of trust triggers the rule and they lock your money in anyway. Heads they win, tails you lose. Now let me tell you about the specific limitations the rule authorizes. Daily withdrawal caps can be set as low as $500 per account holder. Think about that. If you have $50,000 in savings and a medical emergency hits, you could be limited to withdrawing $500 per day. It would take you 100 days to access your own money. Wire transfers can be delayed by up to 14 business days. That is 3 weeks. If you are trying to close on a house, pay a contractor, or move money for any time-sensitive purpose, you are stuck. ACH transfers, the electronic transfers that fund your bill payments, can be paused entirely. Your rent check bounces, your car payment fails, your credit score gets destroyed, all because the Fed decided there was a stress event. And here is the part that reveals their true intention. The rule includes a provision for what they call coordinated messaging. During a systemic stress event, member institutions are authorized to coordinate public communications to maintain depositor confidence. In plain English, the banks can legally collude on what they tell you. They can agree on a script, they can control the narrative, they can all say the same thing at the same time to prevent you from panicking. That is not transparency. That is propaganda. That is coordinated manipulation of public perception. And as of Monday, it is legal. But wait, there is one more provision buried on page 647 of the regulation. It is called the bail-in clause. You may have heard this term before. A bailout is when the government uses taxpayer money to rescue a failing bank. A bail-in is when the bank uses depositor money to rescue itself. Under the new rule, in extreme circumstances as determined by the Federal Reserve, deposits above the FDIC insurance limit of $250,000 may be converted to equity in the institution. Let me say that in plain English. If your bank is failing and you have more than $250,000 in your account, they can take the excess and convert it into stock in the failing bank. You deposited cash, you get back shares in a bankrupt company. Those shares are worth pennies, maybe nothing. Your savings are gone. This is not hypothetical. It happened in Cyprus in 2013. The Cypriot government, under pressure from the European Union, seized deposits above 100,000 euros to bail in failing banks. Depositors lost up to 60% of their money overnight. It was called a haircut. But it was theft. The Federal Reserve just gave themselves the legal framework to do the same thing here. And they did it quietly. They did it without a public debate. They did it while you were distracted by other news. Because they knew if the American public understood what was happening, there would be outrage. There would be bank runs. There would be the exact systemic stress event they claim they are trying to prevent. Now I know what you might be thinking. You might be saying, John, I do not have $250,000 in the bank. I am not a wealthy person. This does not affect me. But that is wrong. This affects everyone. Let me explain why. First, the $500 daily withdrawal cap applies to all depositors regardless of balance. If you have $5,000 in your checking account and you need $2,000 for an emergency car repair, you cannot get it. You are limited to $500 per day. You wait 4 days while your car sits in the shop. You miss work. You lose income, all because of a rule designed to protect the banks, not you. Second, the ACH freeze affects every automatic payment you have. Your mortgage, your rent, your car payment, your insurance, your subscriptions, your utility bills. If ACH transfers are paused during a stress event, every single one of those payments fails. You start getting late notices. You start getting calls from creditors. Your credit score starts dropping. And none of it is your fault. You had the money, you could not access it. Third, and this is the one almost nobody is considering, the rule affects your employer too. How does your employer pay you? Direct deposit, electronic transfer, ACH. If the banking system is in a stress event, if transfers are delayed, your paycheck does not arrive on time. Your employer cannot make payroll. Millions of Americans would suddenly find themselves without expected income not because their company failed, but because the banking infrastructure failed. Think about the cascade effects. People do not get paid. They cannot pay their bills. Businesses do not receive payments from customers. They cannot pay their suppliers. Suppliers cannot pay their workers. The entire economy freezes. Not because there is no money, but because the money cannot move. This is what happened during the 2008 financial crisis. The credit markets froze. Banks stopped lending to each other. Money stopped moving. Companies with plenty of cash on paper could not access it. Businesses that were perfectly healthy went bankrupt because liquidity disappeared. The new Fed rule does not prevent this. It institutionalizes it. It gives the Fed the legal authority to freeze the system deliberately if they believe it is necessary. They are building the off switch, and they will use it the moment they think they are losing control. Now let me tell you who pushed for this rule, because the origin tells you everything about the motivation. The primary advocates for this regulation came from 3 sources: the Federal Reserve Board of Governors, the Bank for International Settlements, and a consortium of the largest banks in America, including J.P. Morgan, Bank of America, Citigroup, and Wells Fargo. Ask yourself a question. Why would the largest banks in America push for a rule that limits their customers' access to their own money? Because they know what is coming. They know their balance sheets are impaired. They know that if a real crisis hits, they cannot meet withdrawal demands. They know that without legal protection, they would face bank runs that would destroy them. This rule is not about protecting you. It is about protecting them. It is about ensuring that when the next Silicon Valley Bank moment happens, the banks can legally lock the doors while they figure out how to survive. You are the one left outside. And here is the most disturbing part. The rule was passed with virtually no public comment period. The standard process for new financial regulations requires a 60-day public comment period. This rule was classified as an emergency measure and given only 21 days. It was published in the Federal Register on a Friday afternoon before a holiday weekend. The comment period ended before most consumer advocacy groups even knew it existed. This was intentional. This was strategic. They did not want public scrutiny. They did not want congressional hearings. They did not want newspaper headlines asking why the Fed is giving itself the power to freeze American bank accounts. So they buried it. They rushed it. And now it goes into effect on Monday. If you think this is unprecedented, if you think the government would never actually restrict access to bank accounts, let me give you a history lesson, because this has happened before. multiple times, in America and around the world. 1933, the United States, Franklin Delano Roosevelt declares a national bank holiday. For 4 days, every bank in America is closed. Nobody can withdraw money. Nobody can deposit money. Nobody can cash a check. The official reason was to prevent bank runs during the Great Depression. The real reason was to buy time for the government to restructure the banking system and confiscate gold from private citizens. That is right. Immediately after the bank holiday, Roosevelt signed Executive Order 6102, making it illegal for Americans to own gold. Citizens were required to turn in their gold coins, gold bullion, and gold certificates to the Federal Reserve in exchange for paper money at a fixed rate of $20.67 per ounce. After the confiscation was complete, the government revalued gold to $35 per ounce. They stole 40% of the value of every ounce confiscated. It was the largest wealth transfer in American history up to that point, and it started with a bank holiday. 1990, Brazil. The government of President Fernando Collor froze 80% of all private bank deposits for 18 months. Not 18 days, 18 months. Citizens were allowed to withdraw only a small amount each month. The justification was hyperinflation. The result was economic devastation. Businesses closed, families were destroyed, people with life savings watched their money sit in frozen accounts while inflation ate away the value. 1991, Argentina. The government imposed a policy called the Corralito. Withdrawals were limited to $250 per week. Bank-to-bank transfers were frozen. The currency was devalued by 70%. Citizens who had saved in dollars saw their accounts forcibly converted to pesos at an unfavorable rate. Middle-class Argentinians became poor overnight. There were riots in the streets. The president resigned and fled the country by helicopter. 1992, Cyprus. The European Central Bank and the IMF forced the Cypriot government to implement a bail-in. Deposits above 100,000 euros were seized. Some depositors lost up to 60% of their savings. There was no warning. Banks closed on a Friday. They did not reopen until the following Thursday. When they finally opened, the money was already gone. 1993, Canada. During the trucker convoy protests, the Canadian government invoked emergency powers to freeze the bank accounts of protesters and anyone who donated to their cause. No court order was required. No criminal charges were filed. The government simply identified accounts and froze them. Some accounts remained frozen for weeks. Some people could not pay their rent, could not buy groceries, could not access any of their own money for political reasons. This is not ancient history. This is the last 3 years. This is the world we live in now. Governments have the power to freeze your bank account, and they use it. Sometimes for economic reasons, sometimes for political reasons, sometimes for reasons they never fully explain. The new Fed rule is simply the American version of what other countries have already done. It creates the legal framework, it establishes the precedent, it puts the infrastructure in place, and once that infrastructure exists, it will be used. Maybe not this year, maybe not next year, but eventually, inevitably, it will be used. And when it is used, the people who prepared will survive. The people who trusted the system will be victims of it. Now I want to pull back and show you the bigger picture. Because this rule does not exist in isolation, it is part of a coordinated strategy. It connects to everything else we have been watching: the de-dollarization, the CBDC development, the war on cash, the consolidation of the banking system. Let me connect the dots for you. The Federal Reserve has been working on a central bank digital currency for years. They call it FedNow. They say it is about efficiency. They say it is about faster payments. They say it is about financial inclusion. That is the marketing. The reality is that a CBDC gives the government complete visibility and control over every transaction. With physical cash, you can transact privately. You can buy something without the government knowing. You can hold value outside the banking system. With a CBDC, every transaction is recorded on a government ledger. They know what you buy, they know where you spend, they know who you transact with, and critically, they can block any transaction they want. A CBDC can be programmed. It can have expiration dates, use it or lose it. It can have geographic restrictions, only spend it in approved locations. It can have category restrictions, not valid for purchasing firearms, or alcohol, or political donations, or gold. The government can decide what your money is allowed to buy, and if you try to buy something outside the rules, the transaction simply fails. This is not a theory. This is already happening in China. The digital yuan has programmable features. The Chinese government has experimented with stimulus money that expires if not spent within a certain period. They have tested geographic limits. They have tested category blocks. They are refining the technology, and the US is watching closely. The new Fed rule on bank access is a bridge to this future. It establishes the principle that the government can control your access to money during emergencies. It normalizes the idea of restrictions. It gets the public accustomed to the concept that access to your own money is a privilege, not a right. Think about what happens when the next crisis hits. The Fed declares a systemic stress event. Banks limit withdrawals. People panic. They want out of the digital system. They want cash. But the Fed says cash is part of the problem. Cash facilitates bank runs. Cash undermines stability. So they accelerate the transition to digital currency. They say, if everyone is on the CBDC, we can manage liquidity better. We can prevent panics. We can protect the system. And just like that, the crisis becomes the justification for eliminating your financial privacy and autonomy forever. The restriction on your bank account this Monday is step 1. The elimination of cash is step 2. The mandatory CBDC is step 3. Each step builds on the last. Each crisis is used to advance the agenda. Do not think I am exaggerating. The Bank for International Settlements, which is the central bank of central banks, published a paper in 2022 explicitly stating that the goal is a unified global digital currency system with programmable features and centralized control. They called it the future of money. I call it the end of financial freedom. And here is how the consolidation of banks fits into this picture. Since 2008, the number of banks in America has dropped from over 8,000 to under 4,500. The small banks, the community banks, the regional banks are disappearing. They are being absorbed by the giants, JP Morgan, Bank of America, Wells Fargo, Citigroup. These 4 banks now control over 45% of all U.S. banking assets. When you have only a handful of mega banks, control becomes easy. The Fed issues a directive, 4 phone calls are made, and every bank in America implements the same policy simultaneously. There is no competition. There is no alternative. There is no bank that says, we are going to do right by our customers and not implement these restrictions. They all fall in line. The new rule accelerates this consolidation. When the next crisis hits, small banks will fail. They do not have the balance sheet to survive restricted access and panicked depositors. The big banks will absorb them at pennies on the dollar, just like they did in 2008 with Washington Mutual and Wachovia. The surviving megabanks will be even bigger, even more concentrated, even more aligned with Fed policy. You are watching the construction of a financial prison. The walls are going up brick by brick, and Monday they add another row. The breaking point, 26 to 30 Grier. So what triggers the crisis? What event causes the Fed to actually invoke these powers? Because they are not going to implement withdrawal caps for no reason. Something has to break first. Let me give you the 3 most likely triggers. Trigger 1, a major bank failure. Not a small regional bank like Silicon Valley Bank. A systemically important bank. One of the big 4. JP Morgan has $3.4 trillion in assets. If JP Morgan showed signs of distress, if there were rumors of liquidity problems, if depositors started moving money, the Fed would invoke emergency powers immediately. They would not wait for the bank to actually fail. They would lock down the entire system preemptively to prevent contagion. How likely is this? More likely than you think. JP Morgan is carrying massive derivative exposures. Their notional derivatives book exceeds $50 trillion. That is not a typo. $50 trillion. If counterparties start failing, if there is a cascade in the derivatives market, even JP Morgan could face existential stress. And the Fed knows it. Trigger 2. A Treasury market dislocation. The U.S. Treasury market is the foundation of the global financial system. Every interest rate, every loan, every mortgage is priced off Treasury yields. If the Treasury market seizes up, if there are no buyers for government debt, if yields spike uncontrollably, the entire system freezes. We came close to this in October 2022. The UK pension crisis caused a flash crash in British government bonds. The Bank of England had to intervene with emergency purchases. A similar event in the US Treasury market would be catastrophic. And with China dumping treasuries, with the deficit at $2 trillion per year, with the Fed doing quantitative tightening, the risk is real. If Treasury yields spike to 7% or 8%, the government's interest payments become unmanageable. Banks holding treasuries face even larger unrealized losses. The $684 billion hole becomes a $1 trillion hole, and the Fed has to choose between letting the market crash or printing money to buy bonds, which destroys the dollar. Either outcome triggers the new rule. Either outcome justifies restricting access to bank accounts. Either outcome ends badly for you if you are not prepared. Trigger 3. A cyber attack. This is the one they are preparing for most aggressively. The government has been running simulations for years on what happens if a major cyber attack takes down banking infrastructure. They call it Cyber Polygon. They run tabletop exercises with the big banks, with the Fed, with the Treasury, with the intelligence agencies. In these simulations, hackers take down payment systems, freeze transactions, and lock people out of accounts. The response always involves emergency powers. It always involves restricted access. It always involves government control of the flow of money. Now ask yourself, is a cyber attack a real risk, or is it a convenient justification? Because a cyber attack is the perfect excuse. It is invisible. You cannot verify it. The government can claim an attack occurred and implement any policy they want. Who is going to argue? Who is going to demand proof? I am not saying a cyber attack will be faked. I am saying it does not matter. Whether the attack is real or staged, the result is the same. Your access to your money is restricted, the new Fed rule takes effect, and you are trapped in a system designed to protect itself at your expense. So, what can you actually do? Because I refuse to leave you with fear and no path forward. The elites have a plan. They have positioned themselves. You need a plan too. Here is what you do before Monday. Step 1. Assess your bank exposure. Look at how much money you have in checking and savings accounts. Understand that anything above $250,000 is uninsured. Anything in the bank is subject to the new access restrictions. Make a clear-eyed assessment of your vulnerability. Step 2. Diversify your banking. Do not keep all your money in one bank. If that bank locks down, you have no access. Spread your deposits across multiple institutions. Consider a credit union, which may be more conservative than a major bank. Consider an online bank as a backup. Having accounts at 3 or 4 different institutions gives you options. Step 3. Keep cash on hand. Physical cash. Paper bills. The rule restricts electronic access. It restricts ATM withdrawals at the bank. But if you already have cash outside the system, you have liquidity that cannot be frozen. How much cash should you keep? Enough to cover 3 months of essential expenses, rent or mortgage, food, utilities, medicine, gas. Calculate that number. Withdraw it gradually over the next few weeks. Do not make a single large withdrawal that might trigger a report. Take out $1,000 this week, another $1,000 next week. Build your cash reserve steadily. If you have $500, keep $500 in cash at home. Secure it properly. A small fireproof safe costs $50. That is insurance. If you have $5,000, keep $2,000 in cash. Spread the rest across 2 banks. Consider $500 in physical silver for an additional layer of protection. If you have $50,000, keep $5,000 in cash. Spread $30,000 across 3 banks, none exceeding $10,000 to avoid reporting triggers. Put $10,000 into physical precious metals, gold coins, silver bars, assets outside the banking system. If you have $500,000 or more, you need a comprehensive strategy. Consider offshore banking in a stable jurisdiction. Consider allocated gold storage outside the U.S. Consider real assets like land. Work with an advisor who understands these risks. Do not keep more than $250,000 at any single bank under any circumstances. Step 4. Reduce your dependence on electronic payments. Start paying for more things in cash. Get comfortable transacting outside the digital system. If the ACH network freezes, you want to be the person who can still buy groceries, still fill your gas tank, still pay for necessities. Step 5. Build a physical asset base. Cash is good for short-term liquidity, but cash can be devalued by inflation. Cash can be replaced by a CBDC. You need assets that cannot be frozen, cannot be digitized, cannot be controlled. Gold has been money for 5,000 years. It survives every government, every currency, every crisis. Silver is gold's more affordable cousin with massive industrial demand. Land produces food and resources. It cannot be hacked. Commodities that people need regardless of what happens to the financial system. I am not saying sell everything and buy gold bars. I am saying diversify out of pure digital exposure. Have 10% to 20% of your net worth in assets that exist outside the banking system. That is your insurance policy. Step 6. Stay informed. Monitor the news for signs of stress. Watch the treasury yields. Watch the bank stocks. Watch for unusual Fed announcements. If you see multiple warning signs converging, accelerate your preparations. Move faster. Get more cash out. Buy more physical assets. The people who got hurt in every banking crisis are the people who waited until it was too late. The lines at SVB on that last Friday were around the block. Those people lost access to their money for weeks. Do not be that person. Be the person who prepared months in advance. Be the person who saw it coming and acted. Let me leave you with this. The new Fed rule going into effect Monday is not the end. It is the beginning. It is the first step in a process that will fundamentally transform your relationship with money. The government is building a system where your access to your own wealth is contingent on their approval, where your ability to transact is monitored and controlled, where your financial freedom exists only as long as they allow it. You have a choice. You can ignore this information. You can tell yourself it will not happen here. You can trust the same institutions that froze Russian assets, that locked Canadian bank accounts, that bailed in Cypriot depositors. You can believe that America is different, that the Fed is on your side, that your bank has your best interests at heart. Or you can act. You can prepare. You can take steps now, this weekend before Monday, to protect yourself and your family. The window is closing. Not next year. Not next month. This weekend. By Monday morning, the new rule is law. The infrastructure is in place. The off switch is installed. And the only question is when they will flip it. Do not wait for them to flip it. Do not wait for the crisis headline. Do not wait for the lines at the bank. Be ahead of the curve. Be prepared. The new Fed rule is the most direct threat to your bank account that I have ever covered on this channel. But it connects to a larger pattern. The de-dollarization, the CBDC rollout, the consolidation of banks. If you want to understand the complete picture, if you want to see the exact timeline of how this unfolds, I created a video that maps out the entire agenda from now through 2030. It shows you what they are planning and when they plan to do it. That video is right here. Click it now before this information gets buried. I will see you there.